Good afternoon. It's a real pleasure today to have Yves Mersch with us for Afore Consulting discussion with. Really, Yves does not require any introduction, but just for those in case you don't know, Yves has for the last 8 years been a member of the executive board of the European Central Bank and also for some of this time and in the last few years a vice chair of the supervisory board. It's a real pleasure to have you with us, particularly with everything that's going on with COVID and so on and so forth, that you've taken out an hour to speak to us. Maybe I can start, Yves, by just looking at monetary policy. There was a monetary policy meeting at the end of October. How do you see the functioning of monetary policy in the current environment, in the COVID environment?
Monetary policy still has the advantage of being able to react rather rapidly because it is not bound by lengthy procedures, as is very often the case in other policy-making areas. Monetary policy also has an important element in so far that it determines the financing conditions under which an economy is financed, and which is very important if there are external shocks or if there is a freeze in the economy, as it is happening through a lockdown. From that point of view, we, however, also have to acknowledge that the different instruments that are at the disposal of monetary policy might have a higher efficiency at a higher interest level than we are presently. I think it is for that reason that the monetary policy decision makers have early on claimed that we would be much more efficient if we would be able to react in tandem with fiscal policy and other policy areas. This has, this time around, worked much better than it did during the great financial crisis 2008, 2011, 12. And the measures that were taken by monetary policy in the beginning of this year, in March, were very quickly also relayed and thereby reinforced by measures in the fiscal policy areas. And now, during the second wave, we see the same. I see that for the moment, monetary policy, fiscal policy, regulatory policy, we are still pulling on the same side of the string. And although that might not always last forever, there might be also situations where there would resurface tensions between the different policy objectives. For the moment, this is not the case.
Thank you. One of the points, of course, monetary policy has been the persistent length of negative interest rates. I mean, traditionally, of course, as you say, interest rates are a key element of monetary policy. But I think you've learned to adjust over the last few years in looking at different levers, different vehicles in the use of your monetary policy. How important or how in relative terms do you see now the situation of negative interest rates? Because some of our clients in the industry as a whole remains, of course, quite concerned about the permanent or long-term persistence of negative interest rates for the yield curve, be it in the insurance sector, the asset management sector, for example.
Interest rate is the main instrument in the toolbox of a central bank, and it will remain so. And from that point of view, there is no constraint or limitation on the use of the instrument of interest rates, at least not in theory. There might, however, in an environment of a longer period of lower interest rates, be some side effects. And these are the considerations that we have to factor in. To what extent are these side effects diminishing the additional return of such an instrument compared to other instruments that we have developed during the crisis, and which have also showed that they would produce consequences which are comparable to those of a direct interest rate cut or increase.
So one of those instruments, I guess, has been the purchasing policies of the European Central Bank, the most recent one being the PEP, the emergency purchase initiatives around COVID. There have been previous ones How do you see this has led to a significant increase of the balance sheet, of course, of the European Central Bank? How do you see that evolve? I know there's been some criticism around that. How do you see this evolve? And also in the medium to long term, how do you see the ECB getting out of this again? Or do you think this is a permanent feature of the balance sheet going forward?
Just as I said, we still have at our disposal the instrument of negative interest rates, but it has to be complemented with mitigating factors in view of, on the one side, the negative consequences, and on the other side, in view of the uncertainty that are related to something that is called the reversal rate, where more of the same will have not a diminishing effect, but even the contrary effect of what has been thought. So the same goes with purchasing. You cannot purchase up the same market if you pretend or if you are obliged by the treaty to operate in line with a functioning market economy. Therefore, we have always been very careful to design the features of our instruments in order to respect fully the mandates and the limitation to the mandates that we have received in the treaty by primary law, but also through secondary law when it comes to supervisory action. And this continues to be our attitude. That is the so-called proportionality analysis that we do, where we measure the cost and benefits of different instruments, where we see what is in this present circumstances the instrument that has the maximum of traction, and how can we maximize our efficiency by providing a mix of measures whereby the interaction of the different instruments also mutually reinforce each other. And as to the asset purchases, we have since the beginning of the pandemic, we have used the new pandemic emergency purchase program up to nearly half of its total envelope. And we have continued also to pursue our normal asset purchase program to the amount of 241 billion up to now. The PEP, Pandemic Emergency Purchase Program, has been used for a total amount of 567, bringing our total intervention to an amount of 808 billion euros since the beginning of March. Now we have to see what is the available universe and what is the relative share of the purchases that we do and what is the effect of the purchases that we have. You know that the pandemic purchase program pursues another objective than only to signal the monetary policy stance. It is doing that certainly as well, but it also was meant to be a backstop. And especially at the beginning of the crisis, when the risk of market turbulences was quite high, we have been, I find, very efficient by deploying this emergency program to avoid having such turbulences. And they were efficient. Now, looking forward, we have to see what is the potential effect of the pandemic on the economy. What are the needs of the economy? Is it more a supply side effect? Is it more demand side that needs support? We all know that for demand side effects, fiscal policy might be directly more efficient than the indirect effect through the lending channel, so the banking channel of the monetary policy instruments. But this is part of our discussions, and in the end, we will take the decisions in terms of what is the most appropriate. Where we agree fully and unanimously is about the need to maintain ample accommodative monetary policy stance in the Union in view of the sheer size of this pandemic crisis and the effects on the economy. However, we also, as I said, are quite satisfied that we have seen complementarity through national fiscal programs. We have seen complementarity through a reaction at the European level, the different programs that have been unfolded and where we hope that they will be implemented as soon as possible without further delay. And that will prompt us to see what is an additional need for monetary policy to maintain this monetary policy accommodation as we consider is quite necessary. If we have, for example, the external financial conditions through the exchange rate bringing a tightening of monetary policy, we obviously would have to counteract in order to maintain the same accommodative stance. Now, if there is a renewed additional shock that materializes through this second wave, even though the measures that have been taken by fiscal authorities are measures in the good direction to prolong the protection, even though the lockdown that has been decided is a lockdown light, which is more protective of the output in different national economies. I think this is the analysis that we have to continue in order to come to the right decisions in a month's time.
Thank you. And I should say, indeed, congratulations on the speed and efficiency of having responded to the crisis, but I think also the 2008 crisis. ECB has been very fast in its action, but I agree with you in this particular crisis, two remarkable additions. Well, at least one is the coordination with fiscal policy that you've pointed out. But also, again, I know it wasn't 2008 as well, but again, the very close coordination with the other central banks across the world. It was remarkable to see the coordination that you demonstrated around these issues. One thing, maybe kind of finishing on the monetary policy side, that I can't avoid is the German Constitutional Court ruling. How do you see that playing out now in the ECB's decision-making going forward around monetary policy?
As I said before, we respect the rule of law and we abide by the rule of law. The constitutional law that is scrutinizing the activity of the ECB is a European law that is under the scrutiny of the European Court of Justice. The European Court of Justice is our natural court and no one else. And the European Court of Justice has ruled on our asset purchasing program, especially the public sector purchase program, and has ruled that it is proportional and that is in line with our mandate. That is the only rule that is binding us. And the European Court of Justice has also said and published a communiqué whereby it says that they are the only ones to guarantee the unity of the interpretation of the European law. And anyone who would try to deviate from this attempt would be fragmenting Europe and would make European law ungovernable. And I think that in the end would undermine the whole solidarity in Europe and the whole European integration process. So this has been very clearly setting the legal framework for our action. Within this framework, you must also know that the German Constitutional Court has addressed its ruling to the German Parliament and to the German government. And they claim that those two institutions, German institutions, seemed not to have exercised its surveillance function to protect the German constitution. The German government and the German parliament looked again at how they assessed the action of the European institution called ECB, and they found that their first assessment, that everything was constitutional and everything was proportional, has been confirmed, especially on the basis of the existing documentation, as well as the additional documentation that we allowed the Bundesbank to forward to its own government and to its own parliament to complete their assessment and confirm their assessment.
Thank you. I think, if at all, it might be a lesson in the way of cooperation between, as you say, national institutions and the ECB, but not, as you say, questioning in any way the treaty enshrined independence of the ECB. Maybe I can pass over to your experience on the supervisory side, because I think it's also been quite remarkable how the SSM has responded to the financial crisis, how it's also demonstrated flexibility and a kind of more dynamic approach to responding to the crisis collectively for the whole supervised banking sector. How do you see this action compared to 2008, the 2008 crisis? What difference has the SSM made in this particular crisis?
Well, first of all, in 2008, we did not have an SSM. We did not have European supervision. We had no single rule book. We had no banking supervision that was unified in one institution. And especially, we had no mandate for the central bank to exercise this additional task. Now, in 2013, the governments, as a consequence of the crisis, decided to activate a option that was in the treaty and that would allow by unanimity to endeavor the ECB with banking supervision of the most important banks. This was implemented through a regulation as a SMR, and since then we have a single supervisor. Not only that, we have also made big steps forward, not only at European level, but also at the global level, how to strengthen the resilience of the banking sector in all our jurisdictions around the globe. And these global regulations have been implemented also at European level. As a consequence, the European banking sector entered into this second crisis after the great financial crisis on a much sounder footing than it entered the first global financial crisis in terms of capitalization, in terms of surveillance, in terms of operational transmission of information, allowing rapid policy reaction. So from all these points of view, it allowed us at the SSM level to react also quite rapidly, practically in real time, together with monetary policy, in offering the European system of the European mechanism of supervision to allow the banking system operational relief, capital relief, liquidity relief, at the same moment that the liquidity relief came through monetary policy action, and at the same moment that national fiscal policy also introduced public guarantees and moratoria. You see, all these measures complemented each other and all together were extremely helpful to avoid that we would have a self-reinforcing crisis and a vicious circle starting to come into place. And we continue now, of course, to see how long can this last, because these are all emergency measures. And to some extent, if they have been very helpful, like freezing an economy can be helpful in order to let it fall further. But at one moment, you also have to look at what is the strategy for an exit, because you cannot continuously finance the freezing of an economy at one moment. You have to make the distinction how to allocate scarce resources in a market economy to the most efficient productive units, and how to assess the viability of productive capacity. That is the definition of a financial intermediary, and that in Europe is the banking system, which is a private banking system by and large.
Maybe before I come to the exit question, because I think that's a very important question, and we always look at Japan and the lost decades in Japan as sometimes a comparison that was even before the crisis. But before we come to that, on the prudential side, do you see areas, tools that have worked particularly well over the last 6 months, but also maybe tools that haven't worked as well. One issue that's often being raised in that context is the capital buffers, which have been designed but in reality were not used by the banks because of market pressures and other reasons.
Well, some of the reasons were also directly related to the rapid reaction of monetary policy. When I look at the liquidity ratios of the banks today are higher than they were at the beginning of the crisis because there was ample liquidity made available by monetary policy, because there was collateral that was also eased in order to do not have a shortage of liquidity. And as a consequence, of course, liquidity ratios increased. But at one moment in time, when you start to draw down these liquidity buffers, then they will decrease again. We might not have reached this stage of the crisis because we are still in the stage of the crisis where most of the economy is frozen. And we have seen that the credit limits that were extended by the banking system are beginning to be drawn down by the corporate sector. But by and large, this is still a process that is unfolding. Now, what has particularly well performed, I would say, is the reduction of the non-performing loans, which was quite high in Europe. On the one side, it has performed very well because we were able to reduce the NPLs considerably in Europe. On the other hand, the new crisis struck before we had finished the business. So in some countries, they were still entering the new crisis with a rather high level of non-performing loans, and this might make it even more difficult to respond to a new wave of asset deterioration, which would end up in higher provisioning and possibly also in higher non-performing loans. So that is to be seen how we deal with this. We have maybe also a little bit too late relied on instruments that are easily available for these purposes in other jurisdictions, like securitization. We had at the beginning of the crisis already an increase in market participants who are active in buying up non-performing loans, especially also from the private side, to some extent in some countries on the public side. But the experience of the different countries in this respect is of different nature, and therefore it is premature to draw now consequences. What should be done on the public side at the European level, what should be left to the private side, and what should be left also to the national side. So this is an ongoing discussion. However, it remains that the relief measures, also from the supervisory side for capital, has left capital inside the banking system that can now be used when there will be a capital consumption due to the deterioration of asset quality. And inevitably, when there is a downturn in economic activity, you also have an increase in non-performing loans, you have an increase in capital consumption, and therefore these buffers that had been accumulated are most welcome. Now you ask another question, and that is to what extent is this are the buffers used by the banks? It is true that up to now, the banks have not used the buffers because simply they are still in a situation where the moratoria are preventing some loans or some debtors from appearing as being unable to repay. So the discussion is how do we try to encourage the banks to maintain their surveillance over the quality, intrinsic quality of their debtors, to continue to make the distinction between what is a viable business model in the future, what is the likelihood to repay a loan and what is the unlikelihood. And you know that from supervisory side, there are stages. How you move from one stage to another stage to a third stage. We encourage the banks not to simply say there is a moratorium, we don't look at the loan anymore. No, we encourage them to keep close contact with the people on their balance sheet in order to be at a very early point able to determine what is a viable business, what is the likelihood of some loans of migrating from one stage to another. But for the moment, the fact is that the consequence, the economic outfalls of the crisis are not yet appearing in the bank's balance sheet, which should not be a reason for us to say everything is fine. There will be no outfall. There will be no deterioration of the asset quality. We do not believe a moment that this is a possibility. What we do not know is the dimension of this deterioration of asset quality, both in scope and on the time axis.
I think that's an important point, and we're also looking forward to the Commission's communication in early December on NPLs and the anticipated NPLs. I'm conscious of time, Yves. Would you have another few minutes? I would like to just ideally come back to the point of the exit strategy, and there were two very interesting questions that have come in. Could I keep you for another maybe 5 minutes or so? Thank you, that's very kind. I think you started talking about the exit strategy, and you've already alluded to it in the prudential framework around NPLs and marketing risk at its real value, and that we're currently in a frozen, kind of temporarily frozen economic situation. It's maybe too early to say, but this issue came up at a seminar just last week. What are the type of steps or elements of thought that we might take into consideration as we look towards an exit strategy, whenever that might be?
The first condition is that you have a sufficient certainty, or let's put it, less uncertainty as we presently have about the unfolding of the crisis and the consequence on the balance sheet of the banks. You know that for operational relief purposes, we did not pursue in last year a full-fledged bank stress exercise, but we limited ourselves to a top-down exercise, which gave some orders of magnitude for the banking sector as a whole, but could not be used to project the capital depletion of individual banks. We will now, in the spring of next year, do such an exercise, which will also give results bank by bank. And as a consequence, we will be much better in a position to also see what is the reaction function that we need to have according to the business models of the banks, according to their dependency on the liability side of external funds, internal funds, deposit taking, and so on. And this exercise will be the first done in the beginning of the month of next year. And we have starting already to prepare for that exercise, which is an extraordinarily important exercise in order to use our supervisory instruments in the interest of the resilience and the safety of the European banking system.
Thank you. The first question that came in, we will watch that with close interest, by the way. I agree with you. It'll be a very interesting exercise. The first question came from Michael Cofontaine, a good friend and chair of AFME. I'm paraphrasing his question, which is quite long, but he's making the link between the asset purchasing program, PEP, and the New Generation EU, so the recovery package. His question is if the recovery package is either not negotiated and completed by the end of the year, or actually the uptake by member states is lower because down the transmission line it's more difficult to find the relevant projects. How could this impact the asset purchasing program of the ECB in December? And could we see potentially a fallback to member states borrowing themselves against their own national balance sheet rather than relying on the second generation EU and PEP program?
It is obvious that the setup of the European Union leaves fiscal responsibility at the national level, so it is normal that this is the first line of defense, that is the national level. It is, however, also true that the fiscal space which separates a country's capacity to react has to be measured in view of the sustainability of its endowment. And even though the national debt for the moment does not seem in no country to be totally unsustainable in view of the interest rate and the service for the debt coming in at a lower rate than the growth rate of the economy, one cannot speak of a risk of unsustainability of national debt at this moment. It remains that the debt levels in some countries are extraordinary and historically high, and therefore it has been most welcome in the financial markets that we complemented these national measures by a European response of solidarity. And for the first time, there will be debt issuance at the European level that complement the national level. Now, I agree that we started to get a little bit nervous about the protracted discussions and negotiations that took place among the European legislators. But as of late, we have heard that these measures are to be put into place in due time. And then you have the second issue that came up, that in some countries we will maybe not see a pickup of the European possibilities, but rather rely on national debt issuance that would then be bought up by the European Central Bank. In my opinion, this would obviously need a reaction by the European Central Bank, which cannot be used to circumvent measures that have been put into place at the European level. And we cannot give a guarantee for accommodating such obvious circumvention. But this is part of an ongoing discussion. It is assumptions. For the moment, we have not seen any refusal. We have seen that some countries have submitted their proposals and their program. Other countries have programs which are much less precise. But it is an ongoing discussion in a novel environment at the European level, and I encourage all the member states not to undermine this new European solidarity approach by reneging on what was so difficult to achieve.
Thank you very much. One very last short question. We initially had planned to also cover the ECB's plans for the digital euro or CBDC. The question that came in actually fits in quite nicely, and that's just a question on how you see, in the light of the conversation we've had, how a digital euro might impact the transmission mechanism of monetary policy going forward. Because the math is you could distribute more directly to the households and to the underlying corporates who you want to reach, sidestepping the banking system to some extent. But with that, of course, comes the lack of control, the lack of the established mechanisms associated with that. I know a lot depends on the design of any digital euro, but maybe you could kind of close with some reflections on that particular point.
Well, let me start by saying we have no objective to bypass the intermediation function of the European banking system. That certainly is not a target, nor an objective. However, we see that some private initiatives from outside the European boundaries could have such an effect as well. And then it would be a privatization of payment habits and private accounts of European citizens outside the European Union without the protection that could be offered by European laws. And that is something where we have to react against. And that's why we also made it very clear that any initiative in this respect must before it is being allowed to be deployed in Europe, be very clearly in line with the new incoming European legislation and also the oversight standards that we are about to set up.
Thank you very much indeed. I'm conscious we overran. I found this extremely fascinating. I'm so grateful for your time, Yves, as always. I'm happy to be able in this technology to communicate in this form. I hope we can do it in person sometime again. But in the meantime, please allow me to thank you very much on behalf of the whole audience and us here for this very insightful and interesting conversation. Thank you very much, Yves, and I wish you all the best over the next few months in managing this continued economic crisis in a steady way that you and the other members of the executive board have done so far. Thank you very much indeed.
Thank you very much, Nick, for having me with you. See you around and stay healthy and safe, all of you.